Welcome to the Loveland Report and the Lone Ranger Show. I am Cleve Loveland, Central Florida's voice of real estate, giving you all of your real estate news alongside the Lone Ranger, Woodburn. We're talking about interest rates. We're talking about this hot Central Florida home market. When will it end? How do you buy a house? How much is your house worth? How much is it going to keep going up?
And where are you going to move if you sell one?
Yeah, that's the hard problem now to solve. I think there's a lot of people that would sell their home, but they're worried about how do I sell it, get the next home, because nobody – I don't say nobody. I've gotten it done. But most, if you got multiple offers on a property, they don't want the offer contingent on your house closing. No. Which in a normal market, that's the way I've done it for 30 years.
Not when you have so many people wanting the same house. And nobody wants to have a contingency.
Yep. And even, it's funny, even in 06, 05, 06, 07, before the wheels came off the bus, we didn't have that problem. People would take it no matter what. They knew it was going to close. But lending is much more responsible now. It makes sense. It does make sense because, like, you have zero defaults.
Yeah, I don't have any defaults.
Yeah, the biggest myth I hear,
unless the client dies.
Yeah, the biggest myth I have out there now is there's a COVID foreclosure wave coming. Yeah. So anyway, but I think the biggest thing I saw this week, Bruce, I want to talk to you about the interest rates, but the biggest thing I saw, news from Fox Business about the median home price in the whole country is now $405,000, up 18% from the year. Up 14% from the year before. And
that's national, though.
That's national.
That's not local.
That's not local. Ours is about 375. So
yeah, but we're up 20%.
But think about this: we are great weather.
Yep.
We're a great state, low tax structure, affordable properties compared to the rest of the country. And then California. Guess what the median price in California is?
Oh God, I'm afraid to ask.
We got it here.
And you know what? We're 20 years behind them when it comes to real estate values. If you follow it, we're 20 years behind them.
California's median price in some of their larger cities is $900,000 to $1.4 million.
For a median price.
For their median price. So
that's $1 million more than we are.
Like I said, this is what's happening. I can't wait till I'm proven right by the figures. We don't have them yet. But Florida's moving from like the 20th most expensive state, I would say, to like number 13 or 14 or 15.
Well, I think that's reasonable.
But think about California. Would you move there?
I only would move to California for the weather.
Yeah, if you hit the lottery and you got great weather, they've got mountains and they got views, but we got oceans. But our median price is literally half what theirs is.
Yeah.
And I think that's just going to readjust.
And we don't have a nut bar running our state. We got a smart governor.
Yeah, and nobody tell us we can't mow our lawn unless we got an electric lawnmower, stuff like that. But the Northeast has a higher tax structure than we do, and snow 5-7 months out of the year. So we've got the great weather. I think this is just a big adjustment of people just saying, well, I can work remotely, or I don't have to live in this high tax state. Florida's going to keep climbing. So even if we have a slowdown, which will probably be, I say, this interest rate rise is probably.
I think even though this summer we could see a slowdown.
I think so, but it's to get to a healthy market. I think we need about 6,000 homes for sale. That's a
we're
balanced
not even
market.
Close to that.
No, we're not. And I get those numbers next. I'll have those on next week's show about where we're at on inventory, and I think we're probably about the same, about a 2 to 3 week supply, depending on what price range you are. And it's going to keep going.
We're hoping that Cleve and I bring value to you. Whether you are currently looking to buy, sell a house, or refinance a house, it doesn't matter to us. We want this show to be about something that we bring value to you so that you can leave knowing a little bit more about what's happening in the economic state of your real estate. Because if you own property, you want to know where your money is. You want to know what your 401k does. You get your Merrill Lynch statement every month. You want to know what that looks like. Yeah. And we're trying to keep you up to date as to what's going on. But I got some interesting news here because if I can follow, do we have a minute to follow on that shirt tail? So I got this article, came out of the interweb, and it was talking about different areas of the country, and I identified a few of them that I thought were important as to the median income. So right now, Daytona has a 25.5% growth. Your median income in January is $258,000 right now. Okay, yep. $258,000 in Daytona. But this is a projected growth that in 2025, that's only in what, 3 more years?
Yeah.
Will be 537. So now I got Lakeland.
Not the income, the home value.
The home value. Did I say income?
Yeah, that's what
I'm sorry.
I'm like, wow, I'm going to move to Daytona.
No, I'm sorry. No, I meant home value.
Okay.
Average home value, median value right now is $258. It's projected in in 3 more years to be 530. That's a double the price.
I think that's optimistic, but I think that's a trend that we're seeing part of the beginning of now.
Well, it's because what they've done is they've factored in the inflation on what it's going to cost to build a home. Because if it costs you that to build a home, people that already own a home aren't going to sell for less than it costs you to build.
Yep.
The builders are actually driving the prices up right now,
Yep.
and they have to because the houses are going up. Lakeland, 263.8 median price right now, projected to go in Lakeland to 640 in Lakeland. Lakeland.
I think that's really optimistic.
640. Well, that's by 2026.
Okay.
So all their
We'll be doing the show then. I don't think I'm retiring soon.
I'm not retiring soon, but here's the thing. Some people may go, you know what? The whole article was about it's going to get too expensive for people to buy. Like, I don't know how people can buy in Santa Monica. Santa Monica is a regular little city.
Well, I think if anybody can bring wages up, like the one thing I see this past I've seen a lot of business. Now, that's not just the service industry and the tourist industry. I think there's a lot of businesses coming to Florida and relocating here because of the tax structure too.
For sure.
And COVID amplified that too. Being told you got to shut down your restaurant chain because of we're all gonna die.
Right.
You got to wear masks inside. You can't serve inside, just outside.
And you got to wear a mask if you're walking to the bathroom.
I know a couple people, restaurant owners up in the Northeast, shut down, came here, opened up a restaurant.
Thank God they did.
Yeah. So
and we welcome them.
And that's just, I think, typical. COVID just amplified our politics to show that we're a friendly state, whatever your party is. Now, I want to ask you, interest rates, are we still in the 4s?
Well, we're still in the 4s, but we're pushing the 5s already. You know, it's interesting because I've been watching. We've lost a lot of ground on the bond market again this week. So week before last, we saw the largest increase in rate in a 1-week period of time since 2013. Mm-hmm. This week was not that much different. So Tuesday, we lost 85 basis points. Now, keep in mind, people don't know what the heck a basis point does to them, mm-hmm. but when we put it in perspective, when we're talking about losing basis points, it's on the bond yield. For every 100 basis points that the bond yield drops, you pay 1 more point. Well, we lost 85 in 1 day. So you went from whatever was at 0 points, cost you almost a full point by the end of the day, right? And that was just 1 day this week.
But I always go back to when I first got in the mortgage business, rates were 8%.
When you first got in the real estate business.
Real estate. When I first got in. And then during the bubble, they were 7%.
Right.
So it's more affordable than
renting.
That's
for sure.
And we've also got all the people that refinanced, the bazillions of people that refinanced over the past couple of years have locked in their savings.
Right.
And it's funny. There's probably, I'm sure you probably wouldn't do it, but I know there's some refi-aholics out there that would call you every 18 months if they could and say, Bruce, can you refi me? I got another $40,000 in credit card debt.
Right.
And they could easily do the loan. That's how a lot of these companies on the radio you hear, like all these
they
ads.
Do. They're churning.
They're churning them.
They're churning them. Yeah.
But with higher rates, it's going to lock people in. And it's funny. I've had some investment properties, and even the way the rates came down, it wasn't worth refinancing because I'm looking at, wait a minute, I've had those properties 15 years.
Your investment properties now, with all the loan level pricing adjustments that Fannie Mae and Freddie Mac have and including second homes, because they're already in the 6s.
Yeah.
They're already in the 6s.
Yep.
So I'm expecting that a primary residence will be in the 6s probably by summer, if not sooner than that.
Yeah.
If not sooner than that. You got to remember, the Fed's only had 1 Fed hike. They're telling us they're going to do 6 more.
And so what this does, so interest rates in the past month, we've lost the 3s, we're in the 4s. That's the house
we're
that
quickly approaching 5s, and in some cases we're in 5s.
And so, but what that does to the buyer out there looking for that house for $500, if they could afford $500, where are they at now? They're about $450, $475.
What do you mean, as far as?
Well, if the rate's gone up that much, what does it take away in their buying power?
Well, I mean, obviously, the higher the rate, the lower your buying power. But everyone is different. It's, you know what? There's no rule of thumb that when it comes to that. Now, I could tell you that for every point that interest rates go up on a $350,000 house, because that was about the average, would cost you about $350. Okay. So if you're talking $500,000, then it's probably about $500 a month more for that rate increase. Yep. So it does reduce your buying power considerably. If those are numbers that you think would be important, I'd be happy to pull up a chart that would give me how much are you planning on paying extra. But here's the thing. You know what? I said this. We had a movie night earlier in the week, And I was talking to a group of folks, and I said, I don't care that the interest rates are going up. I know they're going to hit the sixes. And I'm okay with that. I don't like it as much as the threes, but I'm okay with that. What I'm not okay with is when we don't start seeing that appreciation that we want. Because I don't care if you're paying a 10% interest rate. If you're making if your house is going up 10% per year, you're way ahead of the game.
Yeah.
And if your house is going up 17%, you're way ahead of the game.
Well, and rents are rising.
Rents are going up 20%.
Rents are going to pay, no matter, even if you got a 6% interest rate on investment property, you're going to make money on rent. Or you could do, like we say, and leapfrog out.
For sure.
Have that after you've owned the house for a year or two, and then that primary home has got that low interest rate, you rent that out. So there's all different ways around this.
And Cleve, you always say there is no such thing as
a rich renter.
There's no such thing as a rich renter.
We should brand some T-shirts.
We should. And you know what? I look at that, and if you ask a client out there, hey, do you think you would want a fixed rate or an adjustable rate mortgage? Everybody's going, well, I don't want an adjustable rate. Well, that's what you're doing if you're renting.
Yeah,
it's an adjustable rate.
Yeah.
There's no end in sight. It could go anywhere.
Well, and the market always responds. When I got in the business, my mom they had assumable mortgages.
Sure.
And I remember her when I was in high school working second mortgages on properties. They're selling the house for $120. The first mortgage is
Seller held seconds.
Seller held seconds, and they're negotiating. I remember hearing her negotiating interest rates at 10, 12, 14%.
Isn't that funny?
And it was going to be a 5-year mortgage, and this was the payment on it, and they're going to assume that mortgage. And it's funny, in my 30 years, I've never done an assumable mortgage. And did you ever have it in the beginning there?
I've done some. Yeah, because VA was assumable, and it still is.
With qualifying?
There's no more no qualifying. FHA is still assumable loan. So, and that I don't ever recommend you do that unless we are in a high rate market and you can assume a low rate interest.
Yeah.
The problem with assuming a loan is that the person that you're assuming it from is never off the hook completely.
Really?
Never off the hook completely.
Is that the assumable no qualifying?
No, there is no No, those don't exist anymore.
Oh, I know those went away. Like in
those
the 70s,
don't. Those don't exist anymore.
Those were like gold.
But if you have a mortgage that's an FHA or VA, somebody can assume that. They have to qualify for it.
Hook, yeah.
But here's the thing: what happens when somebody assumes your mortgage? They assume the new debt, but you're still on the hook for it ultimately. But if they default, the lender is not allowed to tell you that the person that assumed your mortgage is in default.
Ruh-roh.
Yes, because there is a right to privacy issue with credit. So you get foreclosed on, but never know it.
Just call the loan arranger at what phone number?
407-250-9144, 407-250-9144, or WeBringYouHome.com.
And if you're thinking about selling, you want to get an idea of how to coordinate that process of how do we get the new home, move out of the old home, are we going to rent it? I can do a market analysis for you to rent it or to sell it. You need any help with that, call me at 407-352-8118.
Yeah, so, and if you have any questions about how to remove those contingencies, I have a system that will increase your odds in a multiple offer situation. If you are a buyer, I'll increase your odds by 30%. I'll elevate you. So if you're tired of making offers on property and not getting them, it may not be because of your offer. It may be because of the lender you're working with. Call me at 407-250-9144. That's 407-250-9144, or WeBringYouHome.com.
How much time we got left, Bruce?
We got about 1 minute.
Okay. I've got something here talking about, it's funny, I'm seeing some talking heads. They're trying to keep the focus off the White House because it's such a disaster there. And I heard some talking heads talking about how the home building industry is headed for disaster. I'm like, how can that be when they got buyers stacked up waiting like just
waiting
lists.
Waiting
lists. This is around the country. And this guy's saying because of inflation and supply chain problems, they've got a problem. No, they
do have a problem.
Well,
but that actually creates more of a demand for the house.
They're actually more profitable, I'd say, at this point. They're not building as many homes. I guarantee you they're making more profit on these things. So don't see their stocks tanking. But this guy is funny. Get your real estate news from somebody in the trenches. Get your mortgage news and advice from somebody in the trenches like Bruce. We're available to call at 407-352-8118. Bruce?
Yeah, or you can call me at 407-250-9144 or WeBringYouHome.com. Be back in 5 minutes with more of the Loveland Report and the Lone Ranger Radio Show.